Hey, Anas.
Hey, what's up?
I'm curious. You're a mortgage lender, right?
Yeah.
Yeah. Easy funding?
Yeah.
Would you ever do a 50-year mortgage?
No.
Oh. I think we should talk about this. What about a portable mortgage?
That's yes.
Okay. An assumable mortgage?
Maybe.
Ah, that's a load. Okay, then you're going to have to stick around to figure out why. Hey guys, it's Kevin DaSilva here with the Living in Los Angeles channel, and today I'm with Atfi, and we're going to be talking about the 50-year mortgage, the portable mortgage, and an assumable mortgage. And here at the Living in Los Angeles channel, our mission is to help you grow your wealth through your living situation. Now that's whether making a great purchase, getting more money from the sale of your house, or making better financial decisions along the way, including upgrading your home, financing and refinancing, home equity line of credit, all kinds of things like this, so that you can grow your wealth.
Whatever he said.
All right, so let's start on the topic of a 50-year mortgage, because you told me that you would not do a 50-year mortgage.
For sure. You want to know why?
I would like to know why.
Yeah, well, first, the interest paid is just insane.
Assuming you even
keep
lived
it
the
for
50 years.
But you never know. You never know lately. The statistics have changed. Before, Californians will change their homes every 7 years.
Yeah.
Now it's a little longer than that.
Yeah, and the average is, in the country, actually, the average is 10 years.
Yeah.
And the average used to be 8. So yeah, you're right. Now, if the average is still 10 years and you make most of your money on the appreciation, I would say, what's the difference? You know, it's going to lower your monthly payment and you're going to make a bulk of your money on the upside.
For sure, if you want, you're sure to get an upside, but in America as a whole, that's not the case. In our market, it is.
But is it?
Good question.
That is a good question. Yes. I study the market every month.
Yeah.
All over Los Angeles County, including each of the different areas and neighborhoods. And one thing I've noticed is this is the first year that we've broken through the price ceiling that had been set in 2022. A lot of people don't realize this. Now, what's the difference between now and 2022? Well, at the beginning of 2022, the average rate was what, 3.125 or 3.5, something like that?
Something like that, even a little lower than that.
No, it's around. It was around.
275 stayed a while too.
It stuck around for a lot of 2021, but
Sure.
So let's just say I just remember at the beginning of 2022, we had 3.125.
Correct.
By the end of the year, we were in the 6s, even 7s.
It took a little longer for the 7s, but definitely the 6s. High 5, 6s.
Okay.
We got there very quickly.
Yeah.
It was bad time, but
It was a
we're
bad.
out of it.
It was a bad time. So, what does that look like? Well, we've clawed our way back from 2022. The prices have finally broken through here in Los Angeles. I hear other parts of the country aren't doing so well, but here in Los Angeles, the prices have broken through.
That's true.
20% price appreciation in Manhattan Beach. That's crazy, but for other reasons, not to do with a 50 or 30-year mortgage. But one thing you got to say is, how much are prices going up? I think LA County was like at the beginning of this year was 2%. We're already up 6% this year.
Yeah, but LA County, if you include outskirts of LA, the outskirts of LA actually got hurt by pricing. The prices went down. For example, the Antelope Valley stagnated for a while. I can say the same in some other pockets.
Okay.
So the average is going down because of it. But if you take in consideration only the west side, the appreciation went quite a bit up.
It did.
So
in the South Bay.
But to get back to the 50-year
San Gabriel Valley, doing very well.
Yeah, it's a high-end market.
Yeah.
Every high-end markets are doing well. It's the mid-range to the lower range that is actually suffering.
So what are you saying, that a 50-year mortgage in this situation does what?
Well, I'll tell you what it does. Obviously, it's a higher interest rate. The more you go on term, it's a higher interest rate.
Okay. Yeah.
What it could do
Nobody's factored that in. I haven't seen what interest rate would be published, but yeah.
Yeah, whenever if we do it today, this is just plain speculation. The average today for me is 599, and it's gonna be an FHA loan most likely because it's a government thing.
Oh.
So it's let's say 5.25 right now.
Yeah.
I believe it will be in mid 6s to 7s.
Mid 6s to 7s.
If we take that benchmark of 5.25.
Yeah.
All right, another disadvantage that I think will happen, and something bad will happen to the market, the prices will go up because of that 50-year mortgage. So a lot of more people are going to qualify, therefore a higher demand compared to the so whatever is offered. So I think the prices will go up. And guess what other price will go up? rent.
Well, that makes sense.
Because it's going to be, at the end of the day, it's going to be a competition between rent
And buy.
and buy. And basically what I see the 50-year mortgage, it's just disguised as rent.
That's one way to look at it. But look at if it helps somebody get into a house, and if they could bring equity to the home
Sure.
because of the lower payments, then I think there's a way to get around it and still come out on top if you're the home buyer.
Can I go further?
Yeah. All right, let's hear it.
All right. So let's say you wanna get rid of that mortgage insurance because it's gonna benefit your loan, and the insurance stays for
50
the
years,
life of
Yeah.
the loan.
Yeah,
right?
yeah.
We don't even know how much they're gonna add up, right?
No.
If you need to refinance, you need to refinance to a conventional, and guess what? There's no 50 years in conventional,
There is not.
so you're kind of stuck with that mortgage insurance throughout the loan. So that's my few cons. I'm sure it works for certain people. I'm not saying it's not.
Yeah.
But tell me why you like it.
I like it just because I'm arguing it, but I think we're in agreement. I'm not a huge fan. It does lower the mortgage payment, but we have a supply issue here in the United States, and this does not solve a supply problem.
No,
You see, this
it makes it worse.
Yeah, this is a demand problem. This is a demand solution.
Yeah.
And so when you have a demand solution, but you have a supply problem, then you're actually putting your foot in the wrong. You basically you're trying to put a Band-Aid on the wrong.
You're not treating the right symptom.
You're not treating the right symptom.
Yeah, for sure.
Yeah, you have a cut on your right leg, but you're putting a Band-Aid on your left.
Exactly. That's exactly.
I just wanted to point out like some things that, hey, look, I think some of the arguments are true. Back when we moved from a 15-year mortgage to a 30-year mortgage, everybody thought the world was going to end then too. And who knows? I'd have to go back and take a look at the statistics, but it's essentially, did it help push prices up at a higher rate? Is something to look at. You do get a lower interest rate at 15 years than you do at 30.
For sure.
Everybody's, now 30 years the customary, but good luck getting 30 years in commercial financing.
No, it's always 20
10
down. Yeah.
Yeah, 10, a lot of 10 years. So anyway, the way I look at it is, we'll adapt to it. Do we need it?
It will be something we can offer. Let's put it that way. If it's there, it just
Some companies already offer 40 years.
40-year interest only, and that's a non-QM loan that needs a higher down payment. So it's still 20% down. That's good if you're gonna hold the property for a year or something like that. That's pretty good, and it helps you qualify because you qualify based on the interest.
General consensus?
It's a no, but can be useful.
To me, it's don't really need it, but it might not be as harmful as everybody's making it seem.
Okay, that's fair.
Yeah. Portable mortgage.
So tell me, what is it?
I'm a yes.
I'm a yes too.
Now, I'll start off since you started off last time. I'm a yes because this is a supply issue. This is a supply
100%,
solution.
100%.
This is a supply solution to a supply problem.
So a lot of our woes, actually.
Well, I'll give you a real life example. I was in Playa Vista, met this couple. They were looking to buy a $2.5 million house.
Sure.
In Playa Vista, freestanding. It's a really nice place. He owns a $5 million house in Venice.
Okay.
Okay. Talked to him. He completely reconstructed the whole house. It was the same shell, but he remodeled the whole thing.
Sure.
So it's his dream house.
Okay.
Okay. He sees the water from his house, everything. And when I tried to, help him sell that house, and at the end of the day, he stopped and he said, "Hey, look, I'm not going to do this." I said, "Why?" He said, "Well, I have a $5 million house, and yes, my mortgage is low. Like it's a $2 million mortgage. But when I sell this, and I go buy the next house because I don't want to roll all my cash over, my mortgage isn't going to go down by a whole lot." So this is somebody obviously makes enough money to own a $5 million house, very wealthy, very well-to-do, but he still wants to carry a mortgage. There are tax incentives to carry mortgage. There are a lot of incentives to carry mortgage. You get to use other people's money, but his payments don't go down by a whole lot to buy this new place. So he put the whole thing on pause. He's lived there ever since. And so for me, if that owner had been able to take his 3% mortgage rate on his $5 million house and take it with him to the next home, he would have brought $500,000 down, $2 million financed, keeping his 3.5% mortgage, and bam, he'd be in, and he'd be living out the next, and that house would be on the market for somebody else to buy.
So it creates fluidity in the market. That's what I like.
Yeah.
And so that way, I have a statistic that 60% of people have rates under 5%, I believe. Now
Wow.
we have 30% of people have rates over 6%. So
Wow.
we still have chunk that just bought.
Yeah.
But it's like we immobilize about 60% of the market. And with this, it seems like to be a solution. Now, here's the thing. How are they going to do it? It's going to create a lot of problems on the guidelines, and it's going to create a lot of problems on the mortgage-backed security. Whatever they package. Now you have a new property as a collateral. So your loan is packaged somewhere, right? You know how MBS work. And
Probably not as much.
now you got to pull back that loan.
Yeah.
Give it another collateral.
Okay.
That may be better or not.
Yeah.
Like in your case, the collateral is lower in price than it is in the first mortgage.
Yeah.
Right? The first mortgage is it's a property of $5 million.
Yeah.
He's trying to downgrade in price. We're talking
Yeah.
about that. So that could be a problem.
Why?
Because the collateral was $5 million. Now you're telling me the collateral is $2.5 million.
Yeah.
So that makes that less desirable in rating. Does it make sense?
It makes sense, but on my side, he's also been paying this mortgage for well over 10 years.
I understand, but I'm telling you what the market will say. That's why it makes it complicated. I'm
Yeah.
all for it.
Yeah.
Just to make it happen.
Yeah.
It's complicated, and I'm sure it's doable for 90% of the loans.
Yeah.
But there will be some guidelines. We have to figure out what the guidelines are.
Let's say hypothetically, when he refinanced his loan, right, and he got 3.5, it was a jumbo loan. It owes $2 million, right?
Yeah.
His home is worth $5 million. At the time that he refinanced, it was worth $4 million, so he's doing 50%, probably rate and term,
Okay.
right? Just getting a better rate.
Uh-huh.
What does it matter if it was 50% equity they would have lent it to him if he was, they would have lent it to him if he was 80% equity.
No, I agree with you. But when you package a loan into a mortgage-backed security, like multiple loans, every single thing counts toward the grading of that loan.
Yeah.
So this, like at 50%, it will be graded a lot higher than if you do a 20%.
Yeah.
You get what I'm saying?
Yeah.
But anyways, that's something we're gonna see. It's very exciting. If it happens, it's very exciting. We're gonna have a lot to do, but we need to figure out what kind of fees the lenders are gonna charge for that, and what's gonna help their bottom line. Trust me, they're not gonna make it happen unless the lenders make money.
True. What are the downfalls of this?
All the upside. I don't see much. I don't see any
downfall in the mortgage-backed security.
No. Maybe the loan officers are not going to make money. They're going to be excluded from it. But,
I'm sure they'll figure out where to get their fees.
Yeah, but I don't see any downside. It's just going to help because
look,
you're going to leave.
If somebody had to pay a point to bring a 3.5% mortgage over to another property,
that's all good.
I'm sure they would pay that point in a heartbeat.
They'll pay.
Yeah.
And also that will liberate the house for the newcomer, for the new purchaser.
So I'm saying, because now people aren't house trapped.
Maybe combined with the 50-year mortgage, it's not that bad after all.
Now, question.
Yeah.
What do you do about the move-up buyer on this portable mortgage?
They need to come up with the extra cap for the down payment,
And
either from their equity, or
because
they're gonna have savings and stuff.
I talked to a lot of people.
Uh-huh.
And one of the top reasons why people in, 2,000, 2,500 square foot homes don't buy 3,000 and 4,000 square foot homes, that yes, it's double the price, it's double the size, but it's not necessarily double the price,
Correct.
right?
Uh-huh.
It's usually 30 to 50% more expensive in these neighborhoods, but their mortgage is 100% more expensive than if they were than their current mortgage. So are they going to come out with new loan products to supplement the difference?
Possibly a second. Like we have already the piggyback HELOCs for purchase.
Oh, you do?
Yeah, because you know how it works is that you want to avoid the jumbo loan. The limit is like, let's say 1.2. I don't know exactly.
It's 1.09 this year.
Yeah,
Next year
and you have a 1.4 purchase. So you can have that $100,000 extra as a HELOC or a HELOAN for that matter, a piggyback that will help you pay for both, but you don't have a jumbo loan. And the advantage of it is to put in less down. That's what most people do. So I think that would be something similar to that.
Okay.
But we'll see what happens.
See what happens. I like the piggyback HELOC.
Yeah. I haven't done one in a while, but they're very good.
All right. And assumable mortgages. Now, there's not a lot of change here, except for the talk is to make more loans assumable.
Now, I have a problem with that.
Oh, okay. So you're a maybe.
No, I'm all for it. I'm just saying that the banks will not allow it. There's no loans in FHA and conventional right now that are assumable. FHA loans from 1991 and before are assumable.
I thought current FHA loans are assumable.
They're not.
I know VA loans are assumable, but you have to be a VA
And
buyer.
you have to be a VA buyer. That's another thing. So basically, the lenders need to make it happen. So the FHFA needs to make it happen. The Federal Housing
Administration. Yeah.
They need to make it happen for both Fannie and Freddie
Okay.
and for FHA.
Mm-hmm.
The VA, you said it's
did
possible,
assumable loan
but you
earlier
have
this
to
year,
be
yeah.
a veteran.
Yeah.
But you have to be a veteran. Now, you can always have the seller carry the note.
Not a lot of sellers want to stick around for that one.
Depends where.
It does depend where.
Yeah.
Yeah.
But assumable loans could be a good solution because it creates, again, fluidity in the
Yeah.
market.
Yeah. It
People
allows.
are gonna more inclined to buy something and let go of their own mortgage.
Yeah.
So it comes down to payment sensitivity.
If I could go buy somebody else who has a 3% and whose price is around where it was in 2022, I'd go buy it.
Of course you do.
Yeah.
Yeah, 275 or 2.5.
2.375 on my mortgage.
I wonder who did that.
You did it. Well, in a nutshell, it seems like we're in agreement, even though we started out not being in agreement. I can't. You can hold the position.
Yeah.
50-year mortgage. No, but probably not as bad as the news is people are freaking out about, right?
Yeah,
So what? Somebody wants to do a 50-year mortgage?
Yeah,
Go
that's
for it.
nobody's business.
Yeah. And then portable mortgage, we're in agreement, allows more fluidity, which in my opinion opens up supply for other people to come buy a home.
Mhm.
Some people are trapped in their bigger properties that they don't want to let go of because the idea of financing their cheaper property. Keep in mind all these taxes. If you watch one of my other videos, you can learn how to avoid, defer, or reduce your tax liabilities. But watch that other video. But yeah, for the people that don't want to avoid, defer, or reduce their taxes, you can just pay the taxes, but then they look at financing the next property. That's a problem. So the portable mortgage solves that.
It does. And the reality is having all three together available in the future is the best outcome.
I guess it's perfect because it's perfect.
Yeah, so you said that the 50-year mortgage will solve your demand problem.
Oh, I don't think we have a demand problem.
No, we don't, but it's going to bring more buyers into the mix. And your portable mortgage is going to take care of the supply problem.
Mm-hmm.
So is the assumable mortgage. So these combinations could be very good.
Interesting.
And can be prosperous for like 20 years.
Yeah. Maybe we'll have to explore what are other ways to solve the supply problem.
New builds.
That's a topic for another video.
Yeah.
Stick around for next time, guys. Hey, it's Kevin DaSilva here, and
This is Anna. Salut tout le monde.
you guys have a wonderful day. And if you like these videos and you want to see them before we publish them to our database, to our network, and to the neighbors, go ahead and hit that subscribe button, turn on your notifications so you can be the first to see these every time we come out.